Hi guys, welcome back to the channel. I hope everybody's doing good. I've got 3 UK stocks which I believe look like good buys heading into November. We've got a good mixture as we have one which is badly beaten down, a second which has lost 50% of its value since IPO in this year, and the last is a good solid company that has something to offer in any market condition. If you enjoy this video, please drop it a like and subscribe to the channel. First company up is Asos, which stands for as seen on screen if you don't already know. The company has been the go-to company for online retailing for probably the last 10 years or so. I remember being introduced to them about 12 years ago through word of mouth and I haven't looked back since. Their selection of clothes, fast delivery and good prices have made it a company I've used over and over again. Disclaimer, I don't actually own any Asos shares at the moment. From being a small UK based company, they are now a massive UK company with a worldwide presence. Even during COVID, a time where retail stocks have struggled, Asos has been performing exceedingly well from a business point of view. Revenue comes in at over £3 billion last year, and this is split up nicely between regions, with the UK and EU making up more than 65% of revenue, but with an ever-growing presence in the US and the rest of the world. Revenue growth, EBITDA, net income and earnings per share have generally been moving in the correct way with good year-over-year growth, and this is expected to be consistent out to 2023. The balance sheet has always been in a strong position, even after carrying out some big acquisitions like the Topshop and Miss Selfridge this year for £330 million. Even after this, they still sit with around close to £200 million on the balance sheet as cash. Absolutely phenomenal. Asos recently announced earnings showing full year results which were great, as the company still reported 36% growth in the UK as well as good sales growth of 21% in the US, EU with 15% and the rest of the world with 6% growth. They do face the same headwinds as most companies just now, with higher input costs, debt and profit, that they expect full year 2022 sales growth of around 10 to 15%, with the first half revenue slowing to mid-single digits. This reflects tougher comparables in the first half, particularly in the UK, and industry-wide supply chain pressures. The group expects full year 2022 adjusted pre-tax profit to fall between 110 million and 140 million, which is down 35% from the previous guidance of 193 million pounds. As you can imagine, this sparked a huge sell-off, as this came at the exact same time as they announced their CEO, who's been with the company since 2009, Nick Beattie, was due to leave. Let's dive into some extracts taken from their latest earnings presentation. The company mentions that they're confident in the scale of the opportunity ahead and are investing to capture growth despite short-term headwinds. They have a clear plan to accelerate the pace and intensity of delivery to guide the next phase of growth. So they are painting a picture here that in the long term they have a strategy in place and they have the experience and personnel to see this out. Revenue growth from 2018 to 2021 has had a compounding annual growth rate of 17% and have managed to bring back earnings to be highly profitable, as back in 2019 profit before tax was only £33 million. Within the same time frame, the balance sheet has strengthened from £42.7 million to £199.5 million. Sales year over year are up 22%, gross margin is down 200 basis points, adjusted EBITDA margin is up 20 basis points, adjusted profit before tax is up 36%, capital expenditure is up 35% and net cash is down 51%, mainly due to the merger and acquisition activities. If we drill into the difference in gross margins, Asos have been good enough to break this down, and the majority of this is because of the freight and duty increasing. A few other key factors such as the exchange rate. Total sales in all regions are up, as well as shipped orders up in 3 out of 4 regions, and active customers are up across the board. The reduction of net cash, as we mentioned, is made up of predominantly the Topshop acquisitions, which took £286 million out of their pockets. Asos has been investing in TGR, Truly Global Retailer, which is a new software management platform to assist with end-to-end product management. They've been trialling it for 6 months to identify issues and iron them out. They've also had a new distribution hub in Lichfield that opened in August and is now ready to ramp up production. The Topshop acquisition looks to be a stellar decision, as it's had year-over-year revenue growth 144% and 400% revenue growth in the US, which is really promising data. Topshop have a similar cost breakdown by region as Asos, with the UK making up 51% of revenues. Asos has a strategic partnership with Nordstrom in the US to drive awareness and growth, with a full product launch expected in the first half of next year, and I think this can really help accelerate their presence and growth in the US. At the time of recording this video, the share price is around £26.40, and you can see the dramatic drop since the highs of almost £60 in April this year. The market cap is about 2.7 billion, with trailing and forward Ps both in the low 20s, and price to sales for the trailing 12 months at 0.75, making this attractively valued. We have 23 analysts covering this stock with an outperform rating and an average price target of £42, which from current prices is about 57% to the upside. We've got 8 buy ratings, 6 outperform, 8 hold and 1 underperform on Asos. The second company I've got here is probably the most interesting stock pick, as it's just IPO'd this year. It's part of an interesting industry and it's lost almost 50% of its value since IPOing. The company is Alphawave IP, who are a UK-based semiconductor IP company. The company designs and licenses high-performance configurable wire connectivity IP platforms. It serves to various markets such as data centres, AI, 5G wireless infrastructure, data networking, autonomous vehicles and solid-state storage. It targets a variety of customers and markets including semiconductor device suppliers, system-level original equipment manufacturers and outsourced semiconductor wafer foundries. The company delivers its technology through 3 distinct delivery models: connectivity IPs, integrated IPs and chiplet IPs. It's important to note here that Alphawave IP do not build the chips themselves. They work in partnership with the likes of Taiwan Semiconductors and Samsung, 2 huge companies, and supply the technology to them. The company's only been around since 2017 and has been experiencing solid growth, with last year reporting massive jumps in revenue, £11.5 million in 2019, up to nearly £35 million in 2020, making heaps of profit in the process, with their 2 regions of business being mainly in North America and Asia Pacific. Forecasted growth out to 2023 is to come in at $230 million, and this is in dollars this segment, so it's to come in at $230 million with solid EBITDA and net income to follow. The company is at this moment highly profitable, even at such an early high growth stage of its business cycle. The balance sheet is solid with net cash of about $500 million and virtually no debt. Interim results released on September 21st, covering the 6 months up to June, paint a really strong growth story. Bookings up more than 490%, 140% increase in revenue and 50% jump in EBITDA margins, multiple tier 1 strategic client wins and accelerated investment to drive future growth, as well as raising full year guidance based on strong global demand and execution. Some of the facts and figures are on the screen, show nearly $200 million of booking in the first half of the year, revenue of $27 million, an adjusted EBITDA margin of 50% with $13.9 million, and after their IPO in London, they managed to get proceeds of $500 million. The outlook and guidance section mentions that they continued their accelerated momentum and new contract wins, with full year 2021 bookings expected to exceed $230 million. Full year 2021 revenue is to exceed $75 million, representing over 125% year-over-year growth, and it's also ahead of the 100% increase that they expected when they IPO'd. EBITDA margins also expected to be over 55%, which is absolutely phenomenal. Alphawave IP have been busy striking up new partnerships and developing their technology. Working from the top down, they closed a master license framework agreement with one of the world's largest chip makers in North America. This agreement will serve as the basis for strategic collaboration and licensing across numerous business units and projects with their most advanced technology beyond 5nm. They closed 3 new design wins in 6nm and 5nm in Q2 2021, including repeat business from tier 1 customers in the US and South Korea, and new business with an AI leader in North America. 5 of the top 8 global semiconductors are now using Alphawave technology. They've expanded their technology in its 7, 6 and 5nm and also delivered the world's first successful tape out of 100GB plus connectivity IP and 4nm technology. And this last section mentions that they're the number 1 player in high-speed connectivity market with the highest market share as recorded by IP Nest. I mean, the company sounds like it's pretty exciting. It's got a good business model, making tons of money, and they're working with all the largest semiconductors as opposed to working against them. So what's not to like about the company? Well, this is the reason here why it tanked more than 50%. Questions have been asked about the company's curiously close links to key partners. One of their partners is a company called VeriSilicon, and it wasn't disclosed in their IPO. The founder and CEO is a chap called MNDI, who's the brother-in-law of Sehat Sutardja, who sits on the Alphawave board as an executive director and a key shareholder, leading people to believe that something fishy is going on, that the company may not be as much of a stand-up company as you think. Also, the group's chair and co-founder John Lofton Holt is also the chair of another semiconductor company called Acronix, which is a customer of Alphawave. So this uncertainty is about Alphawave and how it's supplying its breaking edge technology. Is this in a fair and honourable manner, or is this jobs for the boys types of stuff? And it's potentially made this stock a bargain right now if the growth prospects are still fulfilled. If you go back to June, Barclays were super bullish on the stock, saying it can grow revenue organically out to 2025 at a compounded annual growth rate of 62%, and that share price at the time could double to 650 pence. So really hard one to call here, but just to disclose, I did open a position on this stock just a few days ago because what's life without a bit of risk? Also at the same time back in June, JP Morgan were also extremely bullish on the stock, mentioning some huge numbers that they expect a compounding annual growth rate of 105% between 2020 and 2023. The return on invested capital is substantially higher than the semiconductor peers, hence the company deserves a higher multiple in their opinion. Sandeep from JP Morgan had a price target back then of £4.50 for December 22, and to check Sandeep's credibility, I'll fire up some of his stats from TipRanks. The share price just now is about £2.7, with the market cap sitting about £1.4 billion, and the share price tumbling 40 to 50% from IPO. Trailing PE is high at 159, and the trailing 12 months price to sales is at 39.24. It's always extremely hard to value companies that are expecting such huge growth over such a short period of time, but a company like this losing 50% value could be extremely rewarding in the long run if this bull thesis carries out. 4 analysts covering the stock at the moment, and they're super bullish, with the current average price target implying a 116% increase from current levels. We've got 1 buy and 3 outperform, and I think it's fair to say that this stock is going to be pretty volatile for the foreseeable future, but it makes for a potential interesting and rewarding opportunity. Now we're on to the third and last stock for this month, and it's a good, solid, well-run company called Mondi, who are a UK-based paper and packaging company, and they work in 4 main areas. These are flexible packaging, corrugated packaging, uncoated fine paper, and engineered materials. The company's revenue were hurt due to COVID, but not in a disastrous way, showing resilience. Mondi also have a worldwide presence, with revenues nicely diversified across the different regions that you can see on the screen just now. Revenue in euros came in at 6.6 billion, but it still had decent EBITDA and net income. 2021 is expected to show improvements, with forecasted revenue of over 7 billion, with it to grow consistently out to 2023. Low debt and highly manageable, with it forecasted to be around 1.8 billion for this year, but it's slightly up, which we'll go into in just a moment. The Q3 trading statement came out on the 7th of October, and it all sounds quite promising even in this inflationary environment. Underlying EBITDA was up to €388 million, up 27% compared to the prior year and up 9% on a sequential basis. The CEO, Andy King, mentions that Mondi delivered strong performance in the third quarter, with higher average prices across the business and strong volume growth year on year against a backdrop of sharply higher costs. Throughout this period of high demand, we remain focused on ensuring security of supply and high quality service for our customers. Our growth is underpinned by our leading packaging portfolio. We continue to develop, innovate and sustainable packaging solutions to help our customers achieve their environmental goals. Each of the 4 areas of their business has either been stable or had good growth, and I've highlighted the sections that mention that they've been able to pass on higher costs to customers, which is exactly what you want at this moment in time to keep profits as high as possible. You're looking for companies which can put these higher costs onto their clients or the end user. Input costs have been significantly higher in the quarter and have saw higher prices for energy, resins, transport and chemical costs. Energy costs in Europe increased through the period and rose sharply at the end of the quarter on the back of material increases in electricity and gas prices, which they expect to remain elevated in the fourth quarter. Mondi give a good outlook, saying that the demand remains strong and they are implementing price increases across the business that will support the recovery of ongoing inflationary pressures. The fourth quarter will be impacted by recent input costs alongside planned maintenance and project related shuts, and that they are well placed to deliver sustainability into future growth. If we jump through some of their financial figures, we can see how revenues increased 5% year over year, with EBITDA coming down 4% alongside underlying operating profit. They paid a nice interim dividend, which is up slightly from last year. This is what caused the lower EBITDA this year, with costs making up the majority of it alongside some currency effects. Debt has come up to 2 billion, but still very manageable at a 1.5 leverage to EBITDA ratio. The majority of the company's earnings come from corrugated packaging and flexible packaging, with both contributing to 37% of total revenue, and rightly so. They have the largest amount reinvested back into the company to keep these growth drivers performing well. And this is the example of the likes of the products what they've been working on to help with sustainability. This one here is an Advantage stretch wrap and designed to be more eco-friendly than the usual plastic wrapping you would get around large packages. Mondi also pay out dividends twice a year, as an interim dividend and then a final dividend, which varies upon performance, but is targeted to be within the cover range of 2 to 3 times on an average cycle. The share price just now is about £18.50, with a market cap of about 8.77 billion, trailing PE of 17.29 and a forward PE sitting in the 11s. Price to sales for the trailing 12 months sitting at 1.47, so this company at the current prices looks like good value, and on top of that, if you buy it just now, you'll be getting a very nice dividend of about 2.9%. On this stock we have 11 analysts covering this, and they have an average rating of outperform. Average price target implies an 18% increase from current levels, with 4 buy ratings, 3 outperform and 4 hold. This is a quality company offering a good dividend and still got potential for capital appreciation over time. So guys, that'll sum up this month's video, going over the 3 UK stocks that I like going into November. If there's anything you like or didn't like about the video, please drop it in the comments below and I'll catch you in the next video. Cheers.